Hello everyone, welcome to the latest TM Brunsdon Market Update. I hope that you're all keeping safe and well as we adapt once again to the changing COVID guidelines. I'm pleased to have with me once again Mark Shields, Investment Manager from Brooks Macdonald, who will be discussing some topical issues with us. Mark, there's been a lot of talk about how the latest COVID changes will affect the economy. What are Brooks Macdonald's thoughts on this?
Yeah, hi Brian. Yeah, absolutely. Obviously, we've sort of been, struck with yet another variant of COVID, and at the moment, at least, it looks to be running quite rampant. And we saw some further changes to or restrictions to what we are able to do, as I'm sure you're aware. Obviously, not going so far as sort of full lockdowns and that sort of thing, but very much a return to some of the restrictions we saw in the earlier part of this year. In terms of the impact we think these are likely to have to the UK economy, we, at the moment at least, expect them to be relatively limited. The reason for that is because the economy has largely adjusted to a work from home type mentality. It has had an impact on parts of the market and may well have a continuing impact on parts of the market, such as leisure, travel, and indeed some of those stocks have been hit quite hard off the back of this news. And if we see this becoming a prolonged event, then we may have to adjust our views on what the likely impact is going to be. However, in terms of the broad impact on the UK economy, we expect it to be fairly limited. At the moment, it does seem to be highly transmissible, but not terribly virulent. So we may see a very large number of cases, but we may not, hopefully, see a large number of serious illness off the back of it as well. The concern is more the fact that obviously if you're getting a very large number of cases, you may not need a large number of percentage of those cases to become ill in order for the healthcare system to be overwhelmed. So even if it is less severe, just by nature of the fact that so many people are getting ill, might essentially overwhelm the healthcare system. But we're seeing some decent information with regards to the effectiveness of the booster program, and again, they're trying to push that very hard. So we're cautiously optimistic that the impact of this should be contained. Obviously, it's something we're keeping a very close eye on. But at the moment, we're not expecting a return to a full lockdown type scenario that we had to sit through in 2020 and the early part of this year at the moment. So we're hopeful that we're not going back to those days.
Okay. So a watching brief, but at the moment, limited effects. Okay, Mark, that leads me on to the next question that is quite high profile at the moment: interest rates. What are your thoughts with regard to interest rates going forward, Mark, and how is it likely to affect the investments?
Yeah, so again, I think this has been a bit of a hot topic, really, hasn't it? And in fact, we saw inflation data from the US come out last week at 6.8%, which is, I think, the highest it's been for 30 years or something like that. So inflation is continued to run hot. We're still seeing that inflation being within certain parts of the economy and not quite so broad based. So we're not seeing things like wage growth inflate at the same time, and that's more, if we start to see that, that's far more worrying, because it means that actually that inflation is becoming entrenched into the economies. So we still believe that we're in a transition or transitory inflationary environment. We expect we might see another month or two of relatively high inflation, but we expect that inflation to then start to moderate. And in fact, we're seeing more and more sort of longer term views suggesting that actually we may start to see some deflation next year. However, we have heard the sort of key central banks, mainly the Fed, becoming more and more hawkish, i.e., more and more willing to withdraw stimulus, more and more willing to consider rate rises. So we expect that the Fed will taper its asset buying program more aggressively, and indeed they've already said that they're going to reduce that program going into the summer of next year. But actually, we sort of expect now that they may well reduce it so that it essentially terminates in March of next year, and we might start to see some rate rises from the Fed in the middle part of next year, maybe towards the tail end of next year. In the UK, we were slightly surprised that the Bank of England didn't raise rates in November. And if we'd been talking about this, a couple of weeks ago, then I would have said that it was very likely that we will see rate rise in December. However, with the emergence of the Omicron variant, it's almost given the Bank of England a bit of a sort of an excuse, as it were, to not raise rates in December and delay until the early part of next year. Now, I still think rates in the UK will go up in the next couple of months, but as to whether it's going to be before the end of this year or the early part of this year, now I don't have any particular conviction either way. I think it may be that we don't see a rate rise until the early part of next year. I think the more important thing to watch really is that the pace and the extent to these rate rises that the central banks do. And at the moment, we're not expecting them to raise rates very quickly. We're not, or a succession of rates very rapidly, and we're not expecting them to raise rates to a very high level. And I think that's the important consideration really, is that markets have pretty much already priced in a few rate rises essentially from the Bank of England, certainly. It's already pretty much priced in the tapering program from the Fed and potentially longer term rate rises there as well. So I think most of this is now expected. I think the bigger risk really when it comes to interest rates is central banks making what would traditionally be termed a policy error and raising rates too fast, too far, and that could well have some implications in the market. But at the moment, we do not think that they're likely to do that because they're very forward with their broadcasting of what they expect to do, and it's not really on their cards at the moment. So something
Okay,
to
Mark.
keep watching, though.
Lovely. So you don't see a return to Maggie Thatcher's 17%
Not
rates at the moment then?
not at the moment, no. Hopefully not. Hopefully not.
Okay.
I don't think they could afford to do that, to be honest, Brian.
Okay. Okay, Mark, moving on to our third question today. Green and ethical investments is of high interest with our clients. Can you broadly outline Brooks' approach to this, please?
Yeah, absolutely. I mean, obviously, we've seen a lot of interest and indeed assets flow into ethical green investments, ESG. That part of the market, it's exploded over the past 3 or 4 years, really. And within obviously the BAM funds don't have a specific ESG or indeed green mandate. However, we do. One of the themes that we're playing in the portfolios at the moment is one of sustainability. So we have a position in a fund that is very much targeting decarbonisation, and I personally think this is a very interesting area where we expect to see significant longer term investment with major economies committing to net zero carbon emissions over the next sort of few decades. So I think it's a really interesting part of the investment universe, and it's a theme that we're playing in both the Brunsden funds. More broadly, we have made some changes to our investment process, and the way in which assets are selected for purchase in our portfolios, or indeed added to our buy lists, now means they need to go through a series of, essentially it is an ESG traffic light system. So they are, if there's any concerns with the funds from an ESG perspective, then if it's a red light, then if a fund is buying something we're incredibly uncomfortable with for whatever reason, then we will remove that from our buy lists and sell the position. But also there's a sort of more of an amber light, which maybe a fund is buying companies that we want to have further discussion with the manager about to fully understand their position in that, and to make sure that we're comfortable with the position in our portfolio. So it's not a hard and fast ESG filter approach. It's more of an approach which makes us aware, or more aware of what the underlying positions in some of our assets are taking on from an ESG perspective. So more of a robust approach when it comes to ESG for all the funds that or assets that we buy within the BAM funds.
Yeah. Okay, Mark. Well, that's a good overview. And I think we'll leave it there at this moment in time. So all broadly positive with the very strange background that we've got these days. So thank you very much, Mark, and thank you very much for watching. As always, if you have any questions, then please be in touch with us. Thank you.